Our next panel is a subject matter that I think is going to be very, very interesting to be covered. It's adopting best practices for manager selection, and currently I think that's going to be a very hot button issue for people going forward. So to explore that subject, we have, let's see here, Anthony Basili, the head of asset allocation at Coinbase, this year's Diamond sponsor. We have Scott Army, managing director at Galaxy, and Steve DeMello, partner at Alborn. Please welcome them all to the stage. Yeah, of course.
Wonderful. Hi, everybody. Thanks for being here. You're in for a treat, so I apologize in addition ahead of time for those who are not here, because they're going to miss out. This is going to be awesome. So what we're going to do, just to frame this for a moment, is we are going to start with kind of a high-level canvassing of the managers that are in this space. So we're not talking about tokens, we're talking about active strategies across the digital asset ecosystem. We're going to have Scott share a little bit of his data that he's pulled for us on that. And then we're going to dive into a specific strategy, right? So we're probably going to pick one, and we'll do it out of a hat as we get through it, to unpack really what are those key components of alpha that are being derived in those strategies, and also what are the key components of operational and counterparty risk that matter for manager selection, right? The topic is best practices in manager selection, which implies that if you're an asset allocator, you've got to do a ton of work to figure out what are the managers doing, which strategies make sense in my portfolio, how do I select those managers, and hopefully you pick the right one that knocks it out of the park, and hopefully you avoid the one that ends up in maybe a bad situation like we've seen last year. So let's dive in. Scott, I'll hand it over to you. Can you take us through the universe of managers from your perspective, and how do you kind of build a taxonomy around that?
Yeah, of course. Hi, everyone. Nice to be here today. So some of this data that I'm going to speak to all comes from our Vision Track database, which is our buy-side intelligence database, similar to a Preqin or an HFR approach, but just very specifically built for digital assets. And this is very hot off the press, as our team just finished their work for end of 2022. So the tracking universe of total crypto-dedicated firms out there is a little over 1,500 firms. When we break that down, the count is roughly split between hedge funds and venture funds. So we have about 670 hedge fund-only firms. We have about 680 venture-only firms. And then the balance is actually what we call platforms. Platforms are suites of products that are either both hedge fund and venture, but also could include passive. And we've actually seen a fair amount of AUM aggregate at those platforms, as you would imagine, given we are a niche asset class. Offering multiple choices across one suite is often a place where allocators go. When I speak about crypto dedicated, I just want to touch on this point specifically. It's not necessarily crypto native. So these aren't folks like reaching down, investing into the space on one deal or two deals or three deals. These are firms with funds with specific mandates dedicated to digital assets. So when we look at the AUM of the space, there's roughly $90 billion of AUM across active and passive. The passive number is about 25% of that space, so call it about $22 billion. The hedge fund number is surprisingly, I think, to this room, probably smaller than most people think. It's about $12 billion, and that's only about 13% of that total. What's unique about that is obviously 2022 was a pretty difficult year in the market. So market assets are down, depending on the index you look at, about 65%. So that number was actually much larger if we looked at it a year ago. It was closer to 30 billion or in excess of 30 billion. The venture number is closer to 57 billion. And when we think about the venture number, we talk about venture assets raised. That's the best way for us to think about it. Otherwise, you're looking at a marked up asset portfolio, and that's going to distort things a bit. What's unique about that venture number is that nearly 90% of that was raised in the last 2 years. 2021, 19 billion, 2022, 34 billion. Only 4.5 billion was raised previous to 2021. The thing one step deeper is that fundraising number actually fell off a cliff in Q3 and Q4, as you can imagine, as the market stopped. So a lot of that was really built into funds closing in Q1 and Q2 of 2022. Mm-hmm. The last thing about this data that I'll mention is on the hedge fund side. what we've seen is a lot of concentration in large firms. So when we look at just the top 20 firms by AUM on the hedge fund side, it comprises nearly 75% of the market. If we zoom back 2 years ago, we ran this in 2020, it was about 50% of the market. So we've seen even more concentration among the top 20 firms, especially on the hedge fund side, and we're seeing a similar effect on venture as well.
Amazing. So roughly $12 billion of total assets today in the hedge fund space.
Hedge fund, yep.
500 plus managers in that space,
Yep.
roughly. How many years have you been tracking data?
Since 2018.
Since 2018?
Yeah.
Any color on 3-year track records and the number of managers that would fit that mold?
Yeah, so on the hedge fund side, probably about 10% have 3-year track records at this point in time. As you can imagine, you know, they grow by the month, they grow by the day, right? But not a lot of firms started or out in the beginning. We actually have probably about 40 to 50% in that 1 to 3 year range. So you've seen a lot of firms tend to launch after a bull run. So you saw 2017 be a big bull run. In 18, a lot of funds launched. 2020, 2021, another big bull run. Later that year and in early 2022, a lot of funds launch. And so, you know, since we started tracking that data, maybe about a little over a third of these funds that we've tracked have closed, as you can imagine, for various reasons, performance or business or otherwise. But yeah, we're starting to see finally like some more 3-year track records. It certainly helps for us from a quantitative analysis lens when we're looking at managers, which was really difficult to do in the beginning.
Yeah, and it's important, your data is really important, and there's not that many data providers that actually have collected all this, so it's great that you're doing this. Steve, from Allboard's perspective, how are you canvassing the landscape of managers, and do you have any different insight?
Yeah, so I think what we're seeing echoes a lot of what Scott's referenced, you know, where our clients have been most active in allocating has definitely been on the venture side. I think there's a number of unique features of the venture capital aspect that kind of fits well into the institutional allocation framework. For one, the closed-ended structure you know, mitigates some of the concerns around valuation, perhaps asset liability mismatch risk. In addition to that, there are venture funds out there that offer exposure to equity without token exposure, and that simplifies some of the operational risk more. And then there are venture funds allow you to take a view on the technology, perhaps without a view on the underlying digital assets themselves, and I think that that's been attractive to some allocators in their boards. And then beyond that, it fits well into the sort of tech VC framework, and so from an allocation perspective, it kind of fits neatly into a bucket, and so we've definitely seen the interest in VC. Interest in hedge funds sort of, it started to culminate, I think, in late 2021 and then into early 2022, as I think the sophistication of some of the trading infrastructure was starting to improve. You started to see more market neutral and quantitative funds and allocators that were more interested in them. But then, of course, you know, May 2022 happened, and I think that exposed the sort of long bias inherent in market neutral funds and perhaps some poorer risk management practices, and I think that's kind of really sent open-ended, sort of actively traded funds reeling a little bit from an institutional interest perspective.
And so, from your perspective, most of your body of work has been on the venture side, because that's where the asset class has started, and we're now evolving into really a hedge fund era for digital assets.
Yeah.
Would you agree with that?
Yeah, that's right. I would say, you know, most of the due diligence we've done has been on the venture side to date. It is expanding into the hedge fund universe as the strategies proliferate and there's more product offerings there, but it's a slow uptick right now given the fundraising environment.
Okay. You touched on performance at the index level, so you've constructed an index with a certain number of managers with a bunch of rules around it. Do you have any, share with us information on maybe how performance looks by strategy across your data set?
Of course, yeah. So we on the hedge fund side specifically, right? We think about a composite index, and then we have 3 sub-strategies. We break it down: fundamental, which is basically just asset selection, token selection; quant, which is what you were just talking about, more momentum, CTA-like strategies; and then market neutral, which is really a beta neutral, delta neutral type approach to the market. If we just look at 2022, our composite index was actually down 38%, which was an aggregate of all those 3 I just mentioned. If we break it out, the fundamental index was down almost identically to Bitcoin, which is really interesting, 64%, 65% for Bitcoin. Quant outperformed, mitigated part of that downside, down about 30%, and then the market neutral index was down 3.8%. So you can
3.8.
see 3.8, yeah.
Wow.
So significant dispersion in 2022. If you look at inception to date, there's a little bit closer correlation simply because you're going to get a bit of a beta effect on all of these strategies, especially from an early standpoint.
Inception today, yeah, they all look good.
They all look good.
Not all of them, most of them. All right, that's incredible. So we're talking about a specific subset of hedge funds and digital assets, market neutral, down 3% on the year, which is much better than public equities did, much better than bonds. And you're talking about, on the other end of the spectrum, you're basically highly correlated with Bitcoin, right, on the fundamental long-only version, right? So this ties into the manager dispersion, right? So it really matters which manager you pick. Hopefully they got the right token, call correct, or hopefully they really were able to control counterparty risk, right? So that level of dispersion, on a month-to-month basis, I guess in traditional hedge funds is, would expect between 1% to 5% between strategies, right? From CTA to macro to others, but in crypto you could see 10 to 50%
massive
differentials,
yeah.
right? So it's extremely volatile at the manager level, which has a lot of impacts to your portfolio and how you think about risk. So let's dive in. Let's pick market neutral because it seems to be the one that may be the most contested right now in terms of the ability to extract alpha in there. So maybe Steve, from your perspective, how was market neutral performing last year, and then what are you kind of seeing in Q1 this year?
Yeah, so from a performance perspective, I think we saw a fair bit of dispersion. Some funds that marketed themselves as market neutral, with returns in excess of sort of minus 30% at the tail end. And so I think, as I was referencing, it highlights the difficulties in expressing a short view on certain assets and some of the inefficiencies in expressing that short view. And that highlights a number of concerns for us operationally when we're looking at market neutral funds and things that we're looking to assess a manager on. And I don't know to what extent this is sort of prevalent knowledge out there, but the first instance is it's quite hard to trade the assets, especially if you're trading across multiple exchanges. In CeFi, even more so if you're trading in CeFi and DeFi. And building, there's no really sort of off-the-shelf system that's going to enable you to do that, and so you've got to build proprietary technology. We're going to be concerned to see how a manager does that and how straight through it is. If the manager is able to pull a single portfolio view of risk to basically see where their portfolio is and where the risk is in their portfolio to be able to manage that effectively. And something that's going to enable them to do that on a 24/7 basis, obviously a unique characteristic of this market. But the market neutral strategy is also going to imply counterparty risk. It's a necessity of the strategy that assets need to be held on exchange and to actively trade. And so understanding how a manager is managing that counterparty risk, who their counterparties are, how they select those counterparties, how actively they're sweeping balances off exchanges into secure custody or qualified custody. And then how managers manage auto liquidation risk is, I think, also going to be key to the success here. And so for managers that are leaving assets on the exchange that are trading on margin, we're looking to see managers with a system ideally that's going to replicate what each of the exchanges is doing from an auto liquidation perspective to be able to predict when margin calls are necessary and when the manager is going to need to move assets to various exchanges to avoid getting closed out of trades. So having the sophisticated tools to do that, I think, is going to be a differentiator operationally, and that's something we're looking to see managers demonstrate.
Yeah, so just to add to that point, so even though I mentioned the index return was down 3.8%, right? They're massive dispersion. We saw a lot of funds close. We had 2 multi-sigma events this year. We had, Terra Luna, or really around Anchor Protocol in the market neutral sense, in May, and then we had FTX in November. Those 2 events it's a 1-2 punch for a lot of the market neutral managers out there. They could sustain 1 perhaps, they couldn't sustain 2. And so we did see a lot of closures in that cohort. When you talk about market neutral and the composition of alpha, it's meaningfully changed from the beginning of 22 to now. In the beginning of the year, even reaching back into 2021, a lot of it was around simple, spot basis arbitrage. It was spot futures arbitrage. It was DeFi yield farming, and it was sort of lending. If you break those 3 things apart, that basis trade was an annualized 35% trade in 2021, and it went negative in 2022. You know, DeFi yield farming was probably artificially propped up from a lot of the VC money in the space that I just mentioned was, you know, piling in aggressively, and a lot of that went away, and certainly there's a lot of counterparty risk there too. The third one was lending, and you know, you have to think about who the counterparty is on the other side, right? Like so it was either lending to you know, an unsecured counterparty directly, or was lending to an exchange who was then lending away, or was lending to a business that was lending to someone else, and it looked pretty good, and it seemed repeatable, and it seemed relatable, importantly, because you could talk to a lending you know, attribution, but that obviously didn't work out well as well. So.
Yeah, so most of the market neutral style of return, maybe the true DeFi market neutral style of return, I'll call it, was largely driven by taking on a lot of counterparty risk, right, in this ecosystem. Do we see that coming back for market neutral? I guess the big question is the alpha driver in market neutral persistent, right? Are they actually creating signals that they can continue to use in crypto, or is it more of just taking a lot of counterparty risk, and are you getting paid for that? Just curious your perspective, Steve.
Yeah, so I mean, as to whether the alpha is persistent, I'll let Scott comment. But from a counterparty risk management perspective, I do think that we are seeing better tools that are enabling managers to trade without necessarily pre-funding transactions, and I think that that's going to be a little bit of a differentiator. You know, there's prime facilities out there, of which I know you're aware, that enable you to, you know, trade on the balance sheet of your counterparty, settle on a T+1 basis while your assets remain in cold storage. I think that that's a bit of a differentiator in terms of managing counterparty risk and not having assets sitting on exchange. And I think we'll see probably more of that activity as we go forward. We're seeing, you know, more usage of OTC counterparties as well that will take some of that counterparty risk for you in exchange for settlement risk. I do think there is a world where we see tri-party settlement as well for transactions over the counter, and I think that that's going to enable you to manage that counterparty risk as well. And so I think over time, the counterparty risk element of it will be reduced where it's not deliberate. And what I mean here is, you know, there's a difference between lending assets to a counterparty in exchange for a yield, and taking counterparty risk where you're not being compensated for it, like when you're pre-funding a transaction and leaving assets on exchange. And I think that latter category will be able to be managed a little better going forward.
Mm-hmm. I agree. I mean, I think something we're spending a lot of time on is thinking about how do you think about qualified custody interacting with whether it's DeFi or exchange risk, and how do you minimize that counterparty risk? And we are seeing some institutional tools get put in place there that are solving these problems. I wouldn't say we're fully solved yet, but like that tri-party is a big one, right?
Yeah.
On thinking about counterparty risk. As to like, you know, is alpha going to persist in market neutral? I think the type of alpha has just changed, right? So I mentioned those three things. Those were to start 2022. If you look on a forward basis, it's looking more like equity market neutral. And what I mean by that is it's either long-short strategies, isolating certain factors. It's, you know, it's delta neutral, it's beta neutral, it's vol targeting strategies. So you may take on a little bit more directional risk or a little more beta there, but you're targeting different metrics that fit in a holistic portfolio. And I think as institutions come in, that's really the lens that they're looking at it, is like, how do I add a digital asset allocation in context of my full portfolio? Not necessarily can I just pick up the beta of an 80 vol asset by entering this asset class. So it's much more nuanced, and I think that will persist.
Just to touch on one of those points, so Scott mentioned DeFi, and I do think DeFi has a role in the future in terms of helping managers manage counterparty risk, obviously transacting peer-to-peer and avoiding sort of that pre-funding conundrum. But you know, we have the view at this point in time that DeFi is not quite ready for institutional capital in prime time yet, and there's a number of reasons for that. I think the AML KYC concerns, I think, has gotten the most amount of ink, and you know, to some degree that's the closest to being solved, and I think, you know, you're relatively close to seeing permissioned DeFi or walleted, you know, passported wallets transacting a DeFi, and I think that's going to enable institutions to comfortably transact, having some degree of certainty as to who their counterparties are. But still, you know, the liquidity pools are small. Some of the trading tools that you're used to in TradFi because of the AMM, instead of an order book, not having things like resting orders and stop loss and limit orders, I think is something that needs to mature. We've seen, I think the number is $2.7 billion in smart contract hacks in 2022, which I think would have been a way bigger story if it wasn't for the fact that there were bigger stories to report on. And so I think like a sort of a standard for smart contract security and how to assess that to comfortably interact with these protocols is important. And then the one that I find the most compelling is sort of the legal risk. And what I'm referring to here is sort of the unknown uncertainty in terms of what your rights are when transacting in DeFi. And I think the most obvious case out there is the Mango Markets Eisenberg exploitation, where the fact set as alleged is that he manipulated the price of collateral to take out a massive loan without any intention of repaying that loan. And the interesting part of that story is that his defense is like, yes, I did all of that, but none of that's illegal in decentralized finance, and that's the defense. And I think seeing like a little bit of greater legal certainty as to what your protections are when you're transacting here is another development that we need to see before DeFi kind of fulfills that mandate.
So it sounds like if you're an asset owner, an allocator in the audience today, you really need help. Right? I mean, there's a tremendous amount of complexity to the architecture of digital asset funds, right? And my hat's off to all the managers in the audience who are putting those together, because it's not easy, right? You've got tremendous volatility, you've got bifurcated ecosystems, you've got reg risk, right? You've got cyber risk, there's all kinds of things in here. So what are some things, I know you mentioned qualified custody on the back end, right? And then connecting DeFi. Like, what are some of the things that maybe the investors in the room need to think about in terms of manager due diligence and ODD and all that stuff? Auditing, for example. Like, how do you think about that?
Yeah, I mean, due diligence it's difficult for this asset class. I think, we estimate that it takes about twice the amount of time as it does for a TradFi strategy. There's just so many different complexities to consider. The strategy is going to dictate what the concerns are, but I mean, still at this point in time, custody and counterparty risk remains top, and that's been consistent, I think, for 4 or 5 years. The change here is that we went from evaluating effectively cold storage, custody, and the controls around that to more active usage of the assets, and that more active usage of the assets obviously requires different forms of custody. Decentralized finance involves smart contract security, assessment, but some of the facets of doing due diligence on crypto managers is the same as a TradFi manager, and ironically, some of the managers that have not performed well on due diligence will do so for reasons that are not related to TradFi. So things like poor disclosures, conflicts of interest that are not well mitigated, weak information security practices, compliance program that's not really well defined or tested. And these are not things that are necessarily unique to digital assets. They're just practices that need to improve. And things that we're working with the managers that we do due diligence on through active feedback to hopefully kind of improve the benchmark there. I don't know, Scott, if...
Yeah, I think that's right. I mean, I think in this space, trust but verify is super important, whether it's ODD or IDD. And I think things that are, simple asset verifications with your administrator, or getting a monthly admin transparency report so you can actually see where your counterparty risk lives. Those things have been part of process, but are even more important in this environment right now. I also think the importance of having proper, control functions separated, middle and back office, finance functions, it's become critically important, because if you don't have a dedicated function to that, we've seen managers run into problems, not from executing their investment strategy, but just the operational complexity of the space.
Have you in your work, have you seen, if you put operational due diligence and manager selection next to performance? Like, is there a pretty high correlation between, to your point, not meeting the threshold and seeing larger dispersion in performance?
I would say now that's the case. I would say that wasn't always the case. To invest in 2017, 2018, you had to do a lot of work, and you had to identify what I would call a lot of yellow flags. And as long as you could sort of identify what that risk was and quantify it to some degree and get comfortable with it, that's why you saw outsized returns. I think as everything becomes a bit safer, you're going to see some compression of what you can get in returns. But generally, I'd say the answer is yes. And most of those larger firms where you've seen AUM aggregate now have very, very professional operations, which makes it easier to invest from an institutional standpoint, certainly.
Which of the strategies across fundamental, market neutral, and others, quant, would you say maybe is the least risky from a ODD counterparty risk perspective? If you had to pick one.
Well, I think maybe if you were going to say it's a quant momentum strategy on one exchange, perhaps yours, like the less things you're having to like actually look at, the less diligence, the simpler the strategy, like then the less complex. And if you can get good performance like corresponding to that, it's an easier diligence process. But I wouldn't say any one is any particularly easier than another in that out of those three.
Yeah.
I think the long only may help from a managing your counterparty risk perspective, assuming these are assets that are all supported and can be stored in qualified custody, segregated trust accounts that are not subject to rehypothecation. You do sort of, I guess, eliminate that risk, which is a big one to consider. But that's going to depend on whether or not the manager is investing in sort of frontier assets that are not supported by custodians, that requires self-custody. And self-custody can range from being quite sophisticated to the opposite of that. And so depending on sort of the universe that the manager is investing in, it's really going to dictate the degree of risk you're looking at.
And it's a trade-off, right? Like the example I just gave, you're actually concentrating your counterparty risk, right? So even if you think it's certain, that's what everyone ran into, with FTX. Is it was rated as a tier 1 exchange by a lot of people,
right? And
you had your bands of risk, and it was it sat in a good framework, but it just wasn't the right assessment of risk.
Right. Yeah. So this is a wonderful canvassing of the landscape. From a institutional investor's perspective, at the end of the day, it's not up to us to pick the managers, right? It's up to our clients who have to take a portfolio construction approach, right, across asset classes, and they have to say, well, which type of strategy do I actually want or need in my portfolio, right? They may not want the long-only fundamental version, even though it's maybe somewhat less risky from an ODD perspective. They may say, I only want, a high Sharpe, low beta, no directional risk type of strategy in their portfolio, and that's going to fit next to my other hedge funds in here. So I guess in that vein, what are you both seeing from an institutional LP interest perspective? Have they pulled out of the market altogether? I know it's a tough fundraising environment. What's your perspective, Steve, for you?
It'd be hard to sit here and honestly say that investor confidence hasn't taken a hit through what we've witnessed over the last 6 months. And I think, unfortunately, what we've seen is sort of the return to reputational risk to an extent. And, a lot of allocators felt a degree of reputational risk when considering investing in digital assets. A couple of years ago, I think over time that had reduced, but that kind of seems to have come back. And I think we need to see kind of faith in markets restored and trust in markets restored through some of the reforms that are being discussed, through some of the regulatory clarity out there that people are seeking. And I think, over time, that will probably bring allocators a little bit back to the plate in greater fashion. But right now, we're definitely seeing a pullback in interest and allocations to this space because I think of some of the erosion of trust that we've witnessed.
I would largely agree with that. The thing I would add is I think we've finally gotten to the committee level at a lot of institutions, right? And that's important. And I think now we're at the committee level, and oftentimes you have the internal advocates of digital assets coming to the committee, bringing some of these managers and mandates there, but there's oftentimes one person who's still kind of quite not there on crypto. And so some of what we've seen is packaging it slightly differently as sort of like disruption or non-consensus bets, and like having a pocket of capital to be able to allocate to those types of things has proven a way to push it through committee. I also agree, like sometimes it's just a little bit of time. Like we've had some material events in 2022 in this asset class that just takes some time to play out. So
amazing. That's all we have for you. Scott Army, Steve DeMello, thank you.